Hello and welcome to the Business Standard Morning Show. I'm Kanishka Gupta. It's the 13th of November 2023 and here are the questions we will be answering today. What issues will the 16th Finance Commission face? What role does the Big Five play in Indian governance? What five elements will shape the markets in Samvat 2018? What is the Tata-Singur land case? The tenure of the 15th Finance Commission is nearing its end, and the government has kicked off the process to form the 16th Finance Commission. The panel, which recommends distribution of tax revenues between the centre and the states, and also between the states, is likely to be set up before December. So, what are the burning issues that the 16th Finance Commission is likely to face? Abhijit Kumar has the answer.
The Finance Commission is a constitutionally mandated body set up under Article 280 of the Constitution to examine the fiscal position of the Union and state governments. It then recommends the ratio of tax sharing between the two and lays down principles detailing the distribution of taxes among states. So far, 15 finance commissions have submitted their recommendations since financial year 1951. The recommendation by the Commission on Devolution of Tax spans broadly across two dimensions, vertical and horizontal. The vertical dimension consists of the tax to be shared between the centre and the states, while the horizontal dimension comprises allotment of tax revenues to the states based on their fiscal needs due to varied reasons, such as natural resources, poverty, etc. Currently, the centre allots 41% of its divisible tax pool to the states. The 14th Finance Commission, in its 2015-16 to 2019-20 report, had raised the share of states in the divisible pool of central taxes to 42% from 32%. This was revised to 41% by the 15th Commission in its two terms of reference 2020-21 and 2021-22 to 2025-26. This is because the number of states were reduced to 28. However, the effective share in gross central taxes to the states showed a decline. And this decline has only gotten sharper since 2015. It's not just the shortfall in effective share of states that has been on a downtrend. The high cesses and surcharges on the tax revenue have also been a bone of contention. The issues of cesses and surcharges will be a challenge for the Commission as well. States in the past have accused the central government of not giving their dues of the national tax revenue share. Cesses and surcharges have seen a jump in the last few years, which many states say is wrong as the money collected stays with the centre. Data show that the share of cesses and surcharges in the centre's gross tax revenue collection has more than doubled from 2010-11 to 2020-21. So, will the vertical divide create problems for the 16th Finance Commission?
Actually, the vertical distribution between center and states, the earlier commission said 42% or so, but over time, what is happening, the cesses and surcharges, in fact, they've increased from 10% in 2010 to 20% in 2021. So as a result, what happened, effectively, the share of states has declined. So although they are saying 42%, but effectively states are getting 30% because of the increase in the cess and surcharges, which they don't have to share with the states.
It is important to note that interstate tax differences arise from various ground conditions of the states in terms of their cost of public goods. The states get the tax revenues from the centre in the form of tax devolution and grants. Individual states' share in the centre's divisible pool of taxes is determined by population, per capita income, area, as well as incentive-related factors such as forest cover and demographic change. However, the previous Finance Commission's term of recommendations came under scrutiny because it was asked to take the 2011 population figures into account in determining the expenditure requirements of the state. Southern states, which had performed well in stabilizing population growth, opposed the move and termed it a penalty for good performance. So, will the horizontal divide become a headache for the 16th Finance Commission?
there are some backward regions and there are some advanced regions. And that's the reason where they do have some kind of parameters. One of the parameters that they have is what is called distance approach. Now, if some state is backward, that means they are quite far from the average GSDP growth. So obviously, the the Finance Commission will give more weightage for the distance principle because they have to address the backwardness as the first aspect of the Finance Commission. But then there are many other issues. Like, for example, for the past 3-4 commissions, they're also looking at some of the forward-looking issues like a climate change issue. So for that to address, they've been giving some incentive to the states which are spending more on forest cover. Then there are some revenue deficit grants. Those again, that needs to be discussed in the Finance Commission so that some of the states which are having some kind of constraints in raising resources internally, like for hilly states, they cannot raise resources internally compared to other states. So those issues again will have to be dealt by the Commission.
Another issue that the 16th Finance Commission will have to deal with is the conflict arising out of revenue deficit grants. The Finance Commission gives this grant to the states which remain in current account deficit even after tax devolution. Economists worry that this incentive could prove to be counterproductive because it prevents the states from worrying about raising their revenues. They further point out that the Finance Commissions in the past have been unable to figure out the difference between states' financial incapacity and indifference. So that will remain a burning issue for the new commission. Experts have pointed out that the 16th Finance Commission should expand the tax devolution towards local councils more effectively to further the reach of developmental programs.
Center can give some incentives to states to give devolution to panchayats and all. Because otherwise states think decentralization means it's up to states only. So panchayats also should get some more share in the funds. So that can give development at 3 levels: center, states, and panchayat. The local councils level.
The 16th Finance Commission has its task cut out to narrow the gap between tax devolution in an equitable manner. However, experts believe that the Finance Commission is an institution which is trusted by both the centre and the states. The terms of reference is generally well received by all parties, and with the technical expertise of the Commission, experts are hopeful that the issues will be dealt with.
Staying with the governance theme, a national daily recently reported that top multinational consultancy firms, primarily the Big Four and McKinsey & Co., won at least 308 consulting assignments from different government ministries, departments and organizations between April 2017 and June 2022. In today's special segment, Ayush Mishra and Tariq Ahmed explore the role of Big Five in India's governance. Let's listen in.
The Big Five consultancies, PwC, Deloitte, KPMG, EY, and McKinsey, entered India during the economic liberalization of 1991, offering services like audit, risk management, tax advice, and strategy consulting to businesses. Their impact on corporate governance is evident, ensuring regulatory compliance and facilitating capital raising. With India's digitization push since 2014, these firms are now increasingly engaged in government assignments. According to RTI reports received by a leading daily from various government entities between April 2017 and June 2022, the Big Five consultancies have bagged at least 308 consultancy assignments of 500 crore rupees from 16 departments and 50 organizations. There are a total of 59 government departments, and most of the RTI applications in this matter received a response of either nil information or informed that they are exempted from the Act. These assignments include a range of services for the government, including financial due diligence, retainer for advisory service, hiring technical consultants, and even evaluation of nominations for e-governance awards. The Ministry of Petroleum and Gas and its 4 PSUs have outsourced the most, spending 170 crore rupees during April 2017 and June 2022. State-owned Indian Oil's expenditure on consultancy firms is not included in this. The Ministry of Power is the second biggest contract provider for the consultancies, with assignments worth 166.4 crore rupees. According to the RTI data, PwC backed 92 contracts worth 156 crore rupees from clients like HPCL and Bureau of Energy Efficiency. Deloitte won contracts worth more than 130 crore rupees. EY backed 88 crore rupees contract and KPMG's contract was worth more than 68 crore rupees. McKinsey won 3 big contracts worth 50 crore rupees from Oil India, Numaligarh Refinery and Power Finance. Retired bureaucrat Rajiv Malhotra shares his thoughts on the role Big Five plays in India's governance.
These advisory services are largely being contracted for undertaking analysis, undertaking research in the context of policy making. So although they are playing an increasingly large role in the way government agencies may be working, but their role is largely, in my view, confined to policy making.
Governments engage external consultants when they lack experts in a given field or seek to enhance efficiency in specific projects, says former member of Planning Commission Arun Maira.
Consultants have been providing assistance of introducing technology into business management since the 1990s, ever since the internet and computation technologies became more widely available. And that's how the Big Four got built up. They were providing technology assistance in procedural management, improving procedural management, okay? And so it's a good thing. It's a good thing for everybody, the government included, to take the help of consultants who have done this many times. And they are now able to use the later versions of technology, like artificial intelligence even, to make routine work, procedural work, done more effectively. The second above that and the third above that are to do with changing systems, changing the architecture and performance of systems.
Malhotra points out the positive aspects of consultancies taking up government assignments.
A big plus by engaging consultants or experts in the domain where the government has a shortfall in terms of internal expertise or experience is that you're getting the state-of-art inputs into the policy making process, into analyzing whatever has been referred to these consultancies. So that's a big plus, that you are reaching out to populate your decisions or take your decisions based on domain knowledge, based on expertise that is relevant for that exercise.
However, increased dependence on external consultants can also lead to inefficiency in certain departments. There are also chances of conflict of interests. Consulting firms excel in driving robust enterprises, but do they possess the proficiency to develop effective government systems or provide right advice to governmental entities?
Considering the whole budgets of the government of India would run into lakhs of crores, it's a very small amount. So it's not the matter of the cost being too much, it's are we getting the right advice to solve our problems? And I fear that what has been happening, unfortunately, all over the world, is that consultants are becoming advisors on policy matters in the UK, in the US, in India. And there's a big backlash from policy experts to say that, look, you're getting the wrong advice. Consultants know how to help a private sector company to focus itself to get profits by managing its own processes efficiently. That is not government's job. The government's main job is in the open system to create all-round systems change, which benefits people in different ways wherever they are.
While the money spent on consultants is not significant, experts find value in the advice and methods of these firms to government agencies. However, growing dependence on external consultants could potentially erode the capacity of government entities to manage complex projects and take informed decisions on its policies.
Financial markets, meanwhile, are entering Samvat 2080 on a solid domestic footing, with India Inc. delivering robust earnings growth. All eyes now are on the Lok Sabha elections, which are due in the middle of 2024. Globally, geopolitical tensions and volatility in bond yields continue to weigh on the market sentiment. In our next report, Nikita Vishisht gives a lowdown of the key events that will shape the markets in the new Samvat year.
Equity markets welcomed Samvat 2080 with a special 1-hour Muhurat trading session on November 12. This new Samvat, analysts believe, may see a prolonged period of uncertainty before gaining clarity on road ahead. This is because the global geopolitical situation remains grim, where Israel war has accentuated an already crippled global order due to the Russia-Ukraine war. Speaking at the Business Standard BFSI Insight Summit, Chris Wood of Jefferies said, "The markets are assuming that the conflict won't escalate into a broader West Asia war. Oil prices have barely risen, so clearly any likely escalation has not been priced in." Brent crude oil rose to a high of $94 a barrel soon after the conflict broke down between Israel and Hamas. Investors feared that any possible flare-up in the war could clog already choked supply chains. However, waning demand from the US and China have dragged the prices below $80 a barrel mark for now. In the near term, the trajectory of oil prices would remain a key monitorable for the markets in the new Samvat, as it may alter global inflation trajectory. Besides, its impact on monetary policies and bond yields will be keenly watched.
Savage monetary tightening by the Fed, the US economy is likely to tip into a minor recession in 2024, and that Fed is likely to cut interest rates when there are signs of the economy tipping into a recession. Or it can happen earlier than that. If inflation comes down, Fed will start easing rates and the bond yields will start declining.
Apart from the imported volatility, analysts expect Lok Sabha elections in the first half of 2024 back home to keep investors on the edge.
We have the state elections, we have the general elections. In the worst situations of the current ruling alliance not forming the government, we could see a sharp reaction followed by a recovery as markets dislike uncertainty and value certainty.
The Indian economy has seen a significant growth catch-up in the past decade. Analysts believe the return of the ruling party with a strong majority government will re-rate the markets meaningfully from current levels. And once this political event is behind the markets, the focus would shift to the sustenance of earnings growth.
We would be looking at pickup in the consumer demand and the consumer sentiment in the ongoing festive season, pickup in the earnings as well as the margins for various companies, and FII flows for India.
Overall strength in the domestic economy, elections, earnings growth, inflation trajectory, and peaking of interest rates and geopolitical crisis outcomes over the next few quarters would drive the return for the new Samvat year 2080. On November 13th, domestic retail inflation data for October along with global trends would dictate market moves.
He's making plans for an early retirement. Business Standard.
After the financial markets, let us move on to a case which made nationwide headlines in 2008, the Tata's nano plant in West Bengal, Singur. Hit by protests, the conglomerate had to shift the project to Sanand in Gujarat, but it was in the news again recently after Tata Motors said it has won an arbitration award of 766 crore rupees from the West Bengal Industrial Development Corporation Limited. But what was the case all about? Rimjim Singh explains.
Singur, a nondescript dusty village about 50 kilometers from Kolkata. was once at the cusp of becoming famous as India's automobile manufacturing hub. But it is now known for a very different reason, for a movement that allegedly drove Tatas away from the state and for turning around the fortunes of TMC leader Mamata Banerjee. After coming to power in West Bengal, Banerjee claimed that she didn't drive the Tatas out, but it was the CPIM. She claimed that it was the then left government who had acquired land forcibly and she had just returned it to unwilling owners. Fresh from a thumping victory in West Bengal polls, the then Chief Minister Buddhadev Bhattacharjee announced in 2006 that Tatas would be given almost 1,000 acres to set up a plant to manufacture the Nano in Singur village of Hooghly district. But some locals opposed the move. Within a few months, several groups were formed to oppose the land acquisition, which included Krishi Jami Raksha Committee. Later, several opposition leaders led by Mamata Banerjee too joined the movement. In 2007, Mamata sat on a 26-day hunger strike, which later gained support of several environmental activists. In January 2008, Tata Motors announced that they would launch the Nano at the New Delhi Auto Expo. The Calcutta High Court too upheld the land allocation to the company. But the protests continued. Attempts by then State Governor Gopala Krishna Gandhi to establish truce between Mamata and the government did not succeed. Following this, on 3rd October 2008, Tata Motors decided to pull the production of the Nano out of West Bengal. The company chose a plant in Sanand, Gujarat. Much later, in 2016, the Supreme Court termed the 2006 land acquisition illegal and void. Questions were later raised that the ruling party had forcibly acquired the 997 acres of multi-crop land for the car factory under the Colonial Land Acquisition Act of 1894. Under the law, the state could take over privately held land for public purposes, but not for developing private businesses. And now a 3-member arbitral tribunal has awarded a compensation of 765.68 crore rupees to Tata Motors for losses incurred after the company had to stall its car project at Singur and relocate its plant to Gujarat's Sanand in 2008.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
But over a decade after rolling out of the first car, which was dubbed as the world's cheapest car, Tata Motors has pulled out the plug on Nano in 2020. In April-June 2018, just 65 units of the model were sold. Well, that's all for today. For more news, views and analysis, please log on to business-standard.com. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.